Good afternoon. It's Jeff Christian. It's Friday, the 3rd of September, about 12:25 in the past noon. I'm going to talk about silver today, and it's sort of, well, I had said I was going to give an update on the state of the silver market a few weeks ago, and this is it. Some of the slides that I'm using are from the presentation and from the report, this 2021 Silver Yearbook, which we came out with in early May. And some of the slides are from that report. The data is all in there, as is the analysis. And some of the slides are from the August Precious Metals Advisory monthly report that we produce, updating those things. So in addition to that, we have tentatively agreed to speak at the Silver Symposium, which is, I believe, the 28th and 29th of September in Coeur d'Alene, Idaho. I was a speaker for many years, most of the years at the Silver Summits, which used to be held in Coeur d'Alene, and then Spokane, and then San Francisco. There's a group of people who liked what was going on in Coeur d'Alene, and they're looking to rejuvenate that kind of concept with the Silver Symposium. My plan is to give a speech there, which is going to be an elaboration of the presentation here today, as well as do what we created back there, which was these open forums, challenge your assumptions. And that started actually at the Silver Summit. Well, we were doing stuff like that before, but it started at the Silver Summit when somebody criticized my explanation of silver hedging by non-primary silver producers, and criticized my presentation and his presentation. I said, okay, well, you have an opening at lunchtime, no speaker. Let's just have a thing. I'm not going to have a presentation. Just come in and ask questions. And we did that, and it was very well received for many years. It shifted from being the lunch hour to being after the banquet, and sometimes it went 3, 4, 5 hours. Just open discussion about the state of the world, how mints buy their precious metals, how precious metals trade, monetary issues, financial issues, political issues too. So it was a whole range of topics that were there. We're going to do that again, and then I'll also probably have a workshop on how to invest in gold and silver in a world that's not collapsing. Presentation that I've given in the past in various parts of the world, and I'll probably update it there in a workshop format. So if you're interested, come to Idaho, Coeur d'Alene at the end of September. The weather's beautiful up there. Weather's beautiful up there year round, but it's particularly nice in late September. It's the Silver Symposium. So this is a chart of the long-term silver price. And it's interesting because, you know, glass half empty, glass half full. We know people who will complain that the silver price is so low, and we know people who complain that the silver price is so high. Fabricators mostly on the side of being too high. But this is where the price is. And, you know, we're down around $24. Right now, the price is sort of pushing, it's in a consolidation phase on a short-term basis. And it's got a little bit of risk of another spike down, but it also probably looks like it's more to be played to the upside. And quite frankly, $24, $25 is something of a market clearing price, it seems right now, in terms of supply and demand and investment demand, which has kept the price in that range and in that area for most of the last year or so. So this is the longer term price. Our view, as you guys know, is that we expect the price to rise. The shorter term view, you know, here's the monthly prices really since 2010. You can see that big spike up to $49 and some odd cents for one day in April of 2011. And then it came down and it basically traded between like $13, $14 on the low end and about $19 for most of the time on the high end from late 2014 into the middle of 2020. A little spike up to $20 at one point and a little spike down to $11.80 in early 2020 when the lockdown began. And since the middle of last year, we've been basically trading between, say, $22.50, $23 on the low end, and about $28, $29 on the high end. Of course, there are people who think it should be much higher, but there are a lot of other people who actually know the geology and use and economics of silver supply and demand, and they don't think that it should be thousands of dollars an ounce. Our short-term or intermediate-term projection, the next 8 quarters, is on the right-hand chart here. And you can see that we have the silver price basically consolidating and slowly moving higher, but basically being above $26, moving toward $29, $30 over the next 2 years. Longer term, we do think that the price will rise, but we don't think that the world's going to collapse in the next 8 quarters. And so we don't see investors running into the market. I was very amused to listen to a guy on the internet this week talk about the startling discovery or realization he had that it was investment demand that drives the silver price higher or lower, and not fabrication demand and supply. It's something that we've written about so long that back in the days prior to 1986, when we were part of Goldman Sachs, some of the traders used to complain that they were tired of us writing that it was really investment demand that determined the price levels and directions of gold and silver. And couldn't we say something different in our reports? And we said we could, but then we're not talking about what's important. We have, and I've shown this chart before, you can see, silver market, unlike gold, when investors are bearish on silver, they sell it. When the investors are bearish on gold, they don't buy as much, by and large. There's only been like 3 years since the 1960s when investors were net sellers, and it was very small amounts. There will be investors who are selling, but there are other investors who say, hey, the price is low, everybody's bearish, I'm going to buy at this point. But in the silver market, you have, for example, from 1990 to 2005, 15, 16 years in which investors were net sellers of close to 2 billion ounces, I believe. During that period, Warren Buffett actually bought and sold 129.6 million ounces. He bought it actually in 1996, I believe it was, 1996, 1997, at the point when net sales were at their absolute lowest, and he basically paid less than $5 an ounce for it, every ounce of it. And then he sold it when the price started rising, and it got up to about $9 or $10, so about 2006, 2005, just as the price was starting to rise sharply. But it hit his objective. He had thought he would buy below $5 and sell between $8 and $10, and he sold between $8 and $10. If he had waited a little bit longer, he would have made even more money. If he had waited a little bit longer, he might have, he still would have made more money. But you see these long periods of time when investors are net sellers, and that's what a deficit is in the silver market. Investors selling silver to meet fabrication requirements and to get rid of it because they're bearish. Surpluses are when investors are bidding up the metal away from fabricators and encouraging producers to produce more and secondary recovery for more scrap to come in. So surpluses in silver tend to coincide with higher prices, and you can see that with the red line here. And deficits tend to coincide with lower prices. The period from 1980 to 1989 was a period of declining surpluses. You still had net buying, but investors were buying less and less silver every year. And that actually was reflected in lower prices. The period from, say, 2000 to 2005 was a period of rising prices. You still had net selling by investors, net deficits, but they were selling less metal on a net basis. Other investors were stepping up and buying more silver, and that was applying upward pressure on the price to the point when you got to around 2005, 2006, and investors said, hey, if we stop selling today, we can sell at a higher price tomorrow. While other investors were saying, hey, the silver price has gone from above $5, which it's been below for a decade, 15 years actually, during those deficit periods. It's now above $5 and it's actually above $10. I think it's time to buy silver. So they started buying. We went into a net surplus. Investors were bidding silver away from fabricators. And you saw these large surpluses that got up as high as 200 million ounces, not the 300 or 400 or 500 million ounces that other people who promote silver will say. But on a realistic basis, it actually got up to around 200 million ounces of net investment demand in silver around 2011, 2012. Came off, and it was very scary because it was somewhat reminiscent of what we saw in the 1980s. But last year we saw investors buy more than twice as much silver as they had been buying in previous years. And this year they're buying even more. I'll show you some data on that in a second. So that's really the silver market. We're seeing the silver market rejuvenated, by which I mean we are seeing investment demand rejuvenated. 2019, in the last part, we saw a spurt of it, and then it went away. 2020, we saw more persistent demand. 2021, we're seeing more demand. We don't see it skyrocketing next year. We see it remaining strong, which is why we have the silver price rising modestly. And at some point, we think it gets up to that level of 150 to 200 million ounces, and you see much higher silver prices. But that may be 2023, 2024, 2025. Ask the politicians in Washington, and they'll tell you what they're planning to do. And then you can sort of guess when investors are going to get really scared and buy a lot of silver. These are ETF holdings, and they shot up sharply last year. We've talked about this. We wrote about it in our investment, in our silver yearbook. Not all of the 300 plus million ounces of silver that were bought by ETFs last year were bought by investors. A lot of people look at the ETF holdings as a surrogate for investment demand because primarily these are investors. But last year we saw a lot of bullion banks that were faced with enormous amounts of silver being sold to them, coming and using the ETFs to liquidate some of their physical bullion positions, convert them to ETFs, and then sell the ETFs. And that distorted this figure. You can see here, 2006 to 2010, you had, 75, 80 million ounces on the low end, 150 million ounces a year net purchases. That's a bull market. That was investment demand. Then it got very low. You had a couple of years of small sales, quite different from the behavior patterns that you see in the silver bullion market, where investors will sell long and persistently. Here, you see much less willingness to sell on an immediate basis. We had that big surge in 2020, which kind of distorts this chart. And if you look at 2019 and you look at 2021 year to date, you can see that, hey, it's looking like a bull market again. And you have to sort of adjust your vision to accommodate for that aberration that we saw in 2020. Coinage, more traditional investors in silver, actually is up. And the US Mint is the only mint that publishes monthly data. Their sales through July were up 57% from the previous year. And if you annualize that, you're getting back to those kinds of levels that we saw from 2009 to 2015, 16. The peak levels that we saw in investment demand for silver coins, for the Eagles. Eagles being one of the major silver coins that are purchased by investors. And it's held up very well throughout the year. So you can see, not only did you have that January surge, which persisted into February and March, very common, but you've also seen strong demand in June and July, which actually I think corresponded with some weakness in the prices. So you're seeing stronger investment demand, which is a hopeful sign for price. Total supply, meanwhile, has held up well. Mine production has been falling for several years. It got very low last year. It's picking up this year, and it might actually exceed 2019 levels on the mine production basis. But you also had secondary supply, which has risen. And that secondary supply has held up and actually risen better during that period of lower mine output, so that total supply has held up relatively well. Now, there has been a lot of misunderstandings about mining. The reality is that the new mining capacity, new capacity coming on stream, has actually declined. Back in the bull market, you saw a lot of people say, hey, I can sell my silver for $20, $30, $40 an ounce. I'm going to build or expand on silver mines. And you had, for example, in 2013, 35 million ounces of new capacity, mining capacity, come on stream in 1 year. Got down to 25 the next year. There was a very large mine that came on stream in 2013, and it declined, and it's been declining, and it's gotten very low this year, right? And actually, I think in 2020, probably half of that new mine capacity was one mine that came on stream. Glad to say it's a client of ours. You're seeing a declining trend. And some people have looked at that and said, oh, the world's running out of silver. No, the world's not running out of silver. This decline represents the price decline since 2013, and it represents management decisions and human decisions as opposed to a geological thing. We've shown this chart, this table, and we actually put it in the Silver Yearbook, pointing out that the fact that we're mining the average grade of ore is actually a function of higher silver prices and not a function of the world running out of silver. Some people who would like you to be bullish and think that the silver price is going to $100 or $1,500 say, oh, the world is running out of silver. And if you look, the average grade of ore has fallen from 13 ounces per ton down to about 5.8 ounces per ton. You know, it's less than half of what it was. We're mining lower grade ore, and we're mining that lower grade ore not because we're running out of higher grade ore, but because the price has risen. And as the price has gone from $4, $5, $7 to $20, you can mine lower grade ore. And that actually is an ecological way of husbanding your resources and maximizing your long-term output. When the price is high, you can mine the lower grade stuff. When the price is low and you want to stay in production, you mine a higher grade, waiting for higher prices to go back and get some of that stuff that is just not economical to mine at lower prices. So the decline in ore grade has nothing to do with the world running out of silver and everything to do with the fact that the price of silver is 2-3 times higher than it was 15 years ago. That's simple. Sorry, hate to pop that bubble. And the world's not running out of silver. Again, these tables are in the Silver Yearbook, and I've used them in various presentations earlier this year, but I think it's important because clearly the message hasn't gotten out to everybody. But if you go back to 1988, we had 7.8 billion ounces of silver reserves in the ground. These were mineable, economically mineable reserves in 1988. Between 1988 and 2020, we have mined 19 billion ounces of silver. So more than twice as much silver has been mined in the intervening years than we had in reserves in 1988. And as of 2020, our reserves were 16 billion ounces, more than double what they were in 1988. So reserves have actually risen, even though we've mined 2.5 times as much metal as we had in reserves. And that, again, is a function of price. You have to look at reserves. You also have to look at resources. And resource data is very sparse and hard to come by because of the very definition of resources. They're unproven. They're not drilled out to the extent that reserves are. But there is information on resources. And as the silver price rises, resources, which are sub-economic at a given price, become reserves. And then as the silver price falls, reserves become resources again, and companies start reporting that they have lower reserves, and investors who don't understand that's a function of price get spooked that that company is running out of ore and that the world's running out of ore. And that's not the case. It's a function of the price. It's not a geologic function. Hate to sound like a broken record, but sometimes you just have to repeat yourself until somebody says, oh, I wasn't listening the first 5 times. I'm sorry. Fabrication demand, we had a shallower decline last year than a lot of people thought. Silver demand actually held up relatively well. And we're seeing a softer rebound this year. We're seeing a softer rebound partly because of the chip shortage, which is limiting silver use in newly made automobiles. But we're also seeing softness in some of the other industries. One of the reasons why silver demand held up last year was a lot of people needed electronics. They needed laptop computers and telephones and stuff like that to set themselves up to work at home. And that helped keep demand strong last year. And as a consequence, there's not so much growth in percentage increases from last year to this year in electronic use of silver, as one might think. Solar panels continue to be an area of growth. There was some weakness last year. It's rebounding this year. Electronics are still there. Automotive use of silver in electronics is a big component of that. And you're seeing some other applications. Jewelry demand is relatively flat. Photography, which used to be the largest use of silver, continues to diminish, but they still use about 50 million ounces of silver a year. Ethylene oxide catalysts, there's a big cyclicality there, but that remains relatively strong. You have to excuse the outside sounds here. Just about at the end of my presentation. Silver inventories are at record levels everywhere. You've seen the sharp increase since 2016, and then again last year in London. You have seen a consistent increase over time in Shanghai on the right-hand side. And in COMEX, you have higher inventories in the New York area market than you've ever had before. So you're seeing ample silver inventories. Now, some of those are allocated to ETFs, primarily in London, but a lot of them are working inventories. So the market is relatively well supplied. And anybody who thinks that they can squeeze the market should pay more attention to that. I'll be talking more about this in Idaho, I think. This is the commitment of traders. The chart on the left is the non-commercial gross long and short positions and the net position. The blue are the gross longs, and you can see they're about 350, 450 million ounces of net long positions held by investors in the COMEX futures and options. The green are the gross shorts, and they're down around 150, 170 million ounces, right? The black is the net position. Investors, generally speaking, have been net long silver for most of the period since the newly revised commitment of traders reports were started in 1996. There were commitment of traders reports before that, but the methodology changed in 1996 to the point where you really don't want to compare apples and oranges with the historic data to the current data. We did see a period of time, 2018, 2019, with a big growth in gross shorts and net actually going short for a period of time, but that's behind us now. And we still have pretty large net long positions. Not like we did in the bull market, but pretty healthy. Now, I'll make one point here. In a futures market, when an investor says, I want to buy silver, somebody sells him that futures contract. Now, you can see here, 450 million ounces of gross longs, 160 million ounces of gross shorts. Actually, the actual numbers are in the table. So who's selling them the other stuff? Merchants, commercial entities, market makers who say, oh, I'm a market maker in COMEX futures. And if investors want to buy 450 million ounces of silver and other investors only want to sell 160 million ounces, that's almost 300 million ounces of futures that somebody else has to be willing to sell. And I'm going to do that because I'm a merchant. I'm going to do it because that's my job as a market maker. And I also have offsetting physical positions. Oh, no, I don't. Oh, yes, I do. I have hundreds of millions of ounces, actually probably, in truth be told, more than 1 billion ounces of physical silver that I own. And I need to hedge my price protection for that silver because it's a darn volatile commodity, and my credit department insists that I hedge my position. So I'm a willing to sell person for short futures because I have so much silver. I had a habit many years ago. There was a fellow who was in charge of foreign exchange and precious metals trading at one of the world's largest precious metals trading banks at the time. And we had a habit of having lunch together on the first business day each year. And I remember one year saying to him, you know, there are certain people who vilify you because you publish your data, unlike other banks, and you have this enormous large silver short position that you report on the COMEX. And people vilify you because you're the largest short in the market. He said, and he just laughed. He said, yes, they don't realize that I'm also the largest long in the market. And because I have that long position and the short position, I feel what's happening in the market. I feel what's happening in the physical market because of my physical long position and the fact that I'm supplying silver to mining companies, smelters, refiners, semi-fabricators, fabricators, wholesalers, and retailers, as well as investors. And I see what's going on there. Because of my large position, I have a better idea of what's going on in the physical market than possibly anybody else. And I see what's going on in the futures market because I have this large short position. And I know how hard it is to get positions on and off in the physical market. And I know how hard it is to get them off in the futures market. And that gives me insights that the casual observer or the smaller investor or the smaller market participant just doesn't have. So when the silver price starts to move, this was back in the days when the silver price was firmly below $5, I will be the first to know. And that's true. It's one of the values of being willing to put your capital up, to be a market maker, to finance all of those people in the physical market, and to take the other side of people who primarily want to be short or be long on the futures market. That's the way markets work. Not silver and gold. Markets, not commodities, markets. The same happens in the stock market, the bond market, the currencies markets, the municipal bond market. That's the way markets work. And when you see merchants on a list, they're not talking about a grocery store at the corner. They're talking about futures commission merchants in the case of commodities. And the biggest futures commission merchants are the major banks and brokerage houses. And they're providing the liquidity in the physical market to allow industry to operate. And they're providing liquidity in the futures market for investors who don't want physical metal, but they want to buy exposure to rising silver prices to go long. And the fact that some people hold themselves out as experts and they either do not understand that or refuse to admit that that's the way all markets work is an astounding indictment of society. And on that happy note, I'll wrap it up and take a long 3-day weekend. You can buy our yearbooks online at our website. You can sign up for our retail investment program. You can read about some of the other projects that we have and products that we have, like the Precious Metals Advisory, which gives you a monthly update of these market conditions that I've been talking about with silver, but it gives it to you for gold, silver, platinum, and palladium, and mentions rhodium in passing. You can find an introduction to who we are and what we do on YouTube, so you'll understand better who we are and what we do. And we have open forums for our clients. We had one this week. Pretty interesting, went about 45 minutes, had a variety of questions. We will have a live open forum at the Silver Symposium in late September, as well as a workshop. Maybe we'll see you there. If not, I'll be coming back to you with another video or two next week. Have a good weekend.